Holy smokers, that ain't no dang jokers. Wow, big, huge Amazon news here today. We got to talk about what just came out here. We're going to talk about my perspective on this. Is Amazon stock an easy money stock to buy now? And kind of my perspective on that. Also going to randomly talk about Oatly's earnings in this video as well. I know it's a random subject to throw into this video as well, but Oatly's not like a big enough company, I feel, yet to do like a full dedicated video to their earnings. So I'm just going to cover a couple random numbers from the Oatly earnings in this as well. But if you didn't see, Amazon announces 20-for-1 stock split, $10 billion buyback. The moment I saw that, I said, oh, Amazon's going to make a move, okay? Like, as soon as I saw that headline, I saw 20-for-1 split, I saw $10 billion buyback, and I'm like, okay, it's going to make a move. And sure enough, after hours, it's up over 7% as of right now, flirting with $3,000 a share. And it's just like no doubt, when you see a headline like that, it's going to make a move, okay? And so sure enough, it did, all right? Now, if we think back, this is very, very important, right? If we think back to February 1st, 2022, after the bell that day, Google parent Alphabet announced a same exact thing, a 20-for-1 stock split. Okay. So, this is interesting. That was the first stock split, Google announced in quite some time. And if we think for a moment, let's spend a moment and let's think, what has Google's stock done since that stock split? Because what I saw and what the consensus was, is buy Google stock, it's about to go beast mode. They just announced this split, it's going to go beast mode, right? But what's the truth? Has Google stock gone beast mode? Let's jump into this. Well, no, it has not. The fact is, going into those earnings, right, into that report, the stock was $2,749 a share, right? And here today, the stock is $2,600. So after that announcement, and despite all that hype and all that excitement and all Google stock's going to go crazy, the stock is down since then, right? It made the next day after the news came out, it made a huge spike up to $3,000 plus and then dropped off a cliff. Now, to be fair with Google stock, the market has not been good since then. The market's been bad since then, right? And it's been an ugly market. And NASDAQ, as of yesterday, it went into bear market. Russell's been in bear markets, things like that, right? NASDAQ's much more important for Google. So nonetheless, it has been a bad market. So if the market had been neutral, or dare I say, if the market had been bullish and we had been in a bull market, maybe this is a different scenario, and Google would have moved up to 3,500, moved up to 4,000, and things like that, right? We'll never know what would have truly happened, but at the end of the day, the truth is Google stock is down since they announced their big stock split, which goes to show you it's not like a for sure thing like, oh, this company's announcing a 20-for-1 stock split, their stock's going to the moon. Doesn't work like that, and that's exactly what we saw kind of play out with Google here. Now, obviously seeing this announcement, everybody's like, off to the moon. But where did that even start from? Like, why specifically the retail crowd specifically, why are they thinking like, oh, big company announces stock split, that means the stock's going to the moon? Well, Tesla. Tesla was the one that made everybody believe that if you announce a stock split, your stock's about to go beast mode, okay? And the reason being is essentially Tesla was in a chill out period for several months. And this was in kind of the fall time of like 2020. It was in a chill out period. It wasn't really doing much. And the stock was kind of consolidated, wasn't doing much. And then all of a sudden they announced a stock split and boom, stock went to the moon. And so because that happened and because Tesla is such a famous stock in the stock market, the most famous stock in the stock market, a lot of people started to believe, oh, if a company comes out and announces a stock split, their stock's going to go beast mode. And it's like, that's not really the way it works. The market also made a beast run after that, and Tesla stock made a beast run based upon a lot of fundamental reasons as well as being caught up in kind of a retail hype cycle at that particular time. And so it's very important to remember that Tesla didn't just go up because their stock was splitting. That was just an extra kind of fuel for the fire in a market that ended up starting to go into bull mode again, and a Tesla stock that got caught up into a hype cycle outside of just a stock split, okay? So the truth is Amazon stock doesn't have to make a beast move. But with that being said, I think, in my opinion, I'm going to share with some things with you and why I think actually Amazon is easy money and why I think Amazon stock is about to make a beast run. We'll go over that in just a moment. So real quick, covering the Oatly earnings from this morning here. Oatly, if you didn't know, is a plant-based, they basically make oat milk products that are the best selling out there. Like they move, the volume they move is insane. The velocity of their products is insane. It's gonna become I would call it a very famous brand over the next few years. If you're really in the know, you know about Oatly, but I would say most people don't know about Oatly, but they will in a few years from now. They also make ice cream products and a lot of other products that kind of replace dairy-related products, right? So their earnings just came out. Revenue is up 46.3% year over year. Incredible number. EMA revenue is up about 14%. That's kind of the weaker point of the company. Americas, so think of the US, up 96.5% revenue. Asia revenue was up 97%, okay? These two markets here are the most important markets for Oatly moving forward. In my personal opinion, not to say, the European market does not matter, in the Middle East and the other markets, those matter as well. It's just, these are what's going to, when I look at the next, let's just call it the rest of this a decade, the next 8 years, right, of revenue growth for this company, Americas is going to put up just some incredible numbers year after year after year after year. Based upon their sell-through and kind of their stickiness of their product, no pun intended. And same thing with Asia. The Asia opportunity, believe it or not, could be bigger. I don't want to get too hyped on the Asia opportunity, but the Asia opportunity could be bigger. They just opened up a massive facility in China. That could be bigger than America's and the European opportunity combined. I mean, when you look at a company like Tesla, right, and what numbers Tesla's putting up out of China, and you start to think about Oatly, and you start to think about how many people live in China, for instance. And I'm not even talking about the rest of Asia. I'm just talking about the China opportunity. There's no doubt that opportunity in itself could be bigger than Americas and Europe combined, okay? And so when it comes to Oatly, this is not a company I'm focused on for gross margins right now or net margins or net income or anything like that. I'll start to pay attention to that stuff closer in 2023. But for me right now with this particular stock and this particular company, all I care about right now is their brand, their revenue growth, and their production growth and getting their new facilities up and running. And that's exactly what they're doing. And so they got a massive new facility out in Utah. I'm jacked up. I love this stock. I'm going to continue to buy this stock. I plan to continue to buy the stock for at least like the next, I would call it 3 to 6 months, if not the remaining of 2022. I'm hoping to pick up shares anywhere between $5 a share and $8 a share. That's kind of my ideal kind of price range for Oatly, anywhere between 5 and 8, and just continue to add to my ownership of this company over and over and over again for the remainder of this year. And my hope is that stock price stays low. At the end of the day, Wall Street's going to come flying to the stock. Not in this sort of market right now that we're in the short term, because obviously they don't care about these massive revenue growth companies, 46%. But Wall Street will come flying to this, baby. I can promise you that. It could start in the back half of this year. My hope is it doesn't start till 2023. That's my hope. We'll see what happens there. But yeah, Oatly, just a growth beast, okay? Now let's jump back into Amazon here. So, if you're not familiar with the service I'm using here and kind of what I have set up, let me explain this real quick, okay? So what we're looking at here, this is market cap. This is price to sales ratio over here. So PS, basically it's, revenue of the company versus their market capitalization, price to sales ratio. What we're looking at down here is P ratio, so the earnings of the company versus their market cap or their stock price. So you can either, take it EPS, divide it out by stock price, or you can go net income by market cap, okay? So that's PE ratio, very important metric. And down here, you got price to book metric, okay? And what we're going to see is over here is the numbers Amazon's at today. So it's at a 3 price to sales ratio. It's at a $1.4 trillion market cap. It's at a 42 PE ratio. It's at a 10 price to book ratio, okay? And the numbers over here are going to change based upon where where I'm at in the chart at that particular time and what the company's PE ratio was, price to book ratio, price to sales ratio was at that particular time, okay? So that's what we're at right now. Now, if we go back to some other drops out, so let's go to the March lows for this company, right? March lows right around March 23rd, roughly, of 2020, right? When it hit its lows, it was at $1,600. Now, at that moment, the company was at a price to sales ratio, as you can see over there in the left-hand corner, right? Was at a price to sales ratio of 3.37. That's versus a 3.02 here today. So Amazon today is trading at a cheaper price to sales ratio than what this company traded at in the lows of March of 2020 in that crash. How insane is that to think about, okay? The P ratio on Amazon today is a 42 versus in the lows of the March 2020 crash was an 82. Like, how ridiculously insane is this, right? The price to book in that crash of March of 2020 for Amazon stock was at a 15.25. Here today, Amazon's at a price to book of 10.26, okay? So what this is showing you is that Amazon today trades at far cheaper price to sales ratios, P ratios, and price to book ratios than Amazon did in the lows of the March of 2020 crash, which should just blow your mind, okay? That's insane to think about. That's how oversold this stock has now gotten, right? Now, if we go back to the December 2018 crash, and the lows were right around Christmas Eve of December that year, and I remember it like it was yesterday. It was vicious. I got tore up in that market, okay? And we go back to that time frame. Amazon hit $1,352 a share, okay? Now, during that time frame, the price to sales ratio was 3.2 in this company. It's 3.02 today. So cheaper price to sales today than during that crash. The P ratio at that time was an 82 versus a 42 here today. And the price to book at that time was an 18.47 versus a 10.26. So once again, even in the lows of that crash, right? The December crash, which at one point in December, we were on pace for the worst December in the history of the stock market, which is extraordinary to think about. We got saved in the last few trading days. It saved us essentially from it being the worst December ever. It just was one of the worst Decembers ever. So here today, that stock trades cheaper than it did back then, right? Let's back it up to even bigger time frames, okay? So this, I remember this stock got hit really, really hard in kind of like 2014 and 2015. So if we go back at that kind of time frame there, stock was at about 315-ish. Let's see, kind of at the lows there, about 305 roughly. Okay, so let's draw a line there. So at about 305. And at that time, the company was at, well, it had a negative P ratio on them, right? Their price to sales ratio at that time was cheaper. This was before it made its huge run, right? The price to book ratio was at about 15 versus a 10 here today. So PS was cheaper. That's mainly because Amazon Web Services didn't really get respect and they didn't have their advertising business. So they really just, Amazon back then was really just valued as a retailer. Amazon Web Services didn't get the respect it does today, and their advertising business was like almost non-existent compared to what it is today. So Amazon was really just valued as a retailer in general. And so price to sales was cheaper then, yeah, but PE ratio obviously was a joke because they lost money versus now their profit machine, and price to book was 50% higher than what it is today, right? Now, if we go back, let's say to the double dip recession fears time, right? So right there around February, somewhere right around there, February of 2012, a lot of stocks got hit. Price to sales ratio cheaper, right? But P ratio was at 130 versus a 42 here today. Price to book was roughly in line. So during that double dip recession fear, you could have got Amazon for a really, really cheap price there, okay? Now let's go back to the Great Recession, right? The lows of the Great Recession were in February of 2009, March of 2009, somewhere in there. And so if we go back to that time frame for a good old amazings on there of about, let's call it February of 2009. So you're right about there roughly, okay? So at that time, Amazon traded at a cheaper price to sales ratio. The P ratio was messed up at that time. I think they had some sort of like one-time, advantage that was going for them or something like that. So it was kind of a messed up P ratio. Price to book was roughly in line. So during the lows of let's call it the Great Recession, you could have got this stock for just as cheap, if not cheaper, on valuation metrics, right? And so, nonetheless, when you start to really look at this, and if we really want to play crazy, then we can really go back to like the tech bubble days, which is a whole other thing. So let's see, the tech bubble started wrapping up around, I don't know, what was it, 2002? So somewhere in there roughly. And at that time, price to sales ratio of 1.6. Obviously, they were a money loser. And price to book was negative back then. It was a -3. So you can't even compare it back to that time frame, okay? So what this essentially is going to show you when it comes to Amazon stock. Oh, let's look at this one. Let's look at this one here. So this was 2016. Roughly there, and the stock fell to 500-ish a share. Their price to sales ratio 2.4 versus 3 today. P ratio of 445 this company had on it versus a 42 here today. And a price to book just under 20 versus here today it's at a 10 during that crash that the stock had, right? So what you're essentially seeing here is Amazon is trading pretty much in line with the cheapest it ever has. Even in the depths of these other crashes and corrections that have happened in the past, okay? And so that's why it was either yesterday or the day before, in one of those videos, I said, Amazon is about to make an epic run. And I don't know if it starts in a few weeks from now or a few months from now. But what I can tell you is Amazon is set up as a stock to make an epic run because it does not trade this cheap for very long. It can maybe trade this cheap for a few weeks, maybe a few months, and then it's back on to another huge rally where it's going to rally to $4,000+ a share. And so when I look at Amazon stock and I look at the fundamentals of this company, right, and I look at the valuation of this company, everything's lining up that this stock is about to make an epic run. Now, if you want to talk about throwing some fuel on the fire, go ahead and add in a $10 billion buyback. And go ahead and add in a 20-to-1 stock split. And you just put some fuel on the fire. So Amazon stock's not a stock I personally own, but I got to say the stock is easy money. And this stock will be substantially higher a couple years from now than it is today. And it will go on an epic run again. And everybody will be like, Amazon's back. There it is, okay? And so this is just more fuel for the fire. Regardless if they did this 20-for-1 split and the share buyback, this stock was primed for a massive move up. This is just fuel on the fire. And yes, the stock is easy money. Let me know your guys' opinion in the comment section. I'd love to hear from you guys. As always, much love. Won't be playing any short-term call options or anything like that in Amazon. It is very tempting, but I won't be doing anything like that. So, that's just not my name of the game. I try to stay in my lane, focus on long-term stocks and those sorts of things. So anyways, guys, much love as always. Enjoy the other videos on the channel and have a great day. Also get some free stocks from Moomoo. Pin comment down there. Literally any deposit, you get free stocks. It's like the most amazing deal ever. Check out pin comment.